All right, so we are ready to initiate our second panel. Our second panel will touch on the topic of licensing principle and fintech regulation. Our keynote speaker is Professor Dirk Zetzsche. Professor Dirk is the holder of the ADA Chair in Financial Law, Inclusive Finance, at the Faculty of Law, Economics and Finance of the University of Luxembourg. I would like to welcome Professor to our university and to, well, the floor is yours for your presentation.
Thank you very much. When I became a law teacher, I did that because I wanted to have contact to people. And for that reason, I also decided to travel here and to be in direct contact with the audience. And for that reason, I will also move around a bit. Ladies and gentlemen, maybe I can talk a little bit about myself and meanwhile and my ambition to fintech. Because I wasn't born as a law professor. Yeah? I started as a simple law student. And after law school, I was bored with the law. So I decided that I start a fintech firm. And I did that for 3 or 4 years. And we were good on the technology side, but we lost on the market side. Yeah? Because one thing is very crucial when you do fintech, that you need to understand that the market is always faster than yourself. And so in this regard, we were the first mover, and I like to make this joke that we were also the first loser. Yeah? So because we had, out of 10 globally listed companies, we had wonderful clients, but then we just underestimated the dynamic of the market. But this was a wonderful lecture in life, because I went through this venture capital cycle from basically seed to almost exit and default. Then we had all these issues with tech risk, with compliance issues, with IT security and so on. So in this regard, this full fintech lecture has basically taken 4 years, and also the cost of a very important and expensive master program in the US, because this was, of course, a lot of investment that we put into there. But in the end, I just have to say that I decided then, after a couple of other stints at law firms and so on, that I wanted to teach others about my experience, and much of what I do today is fintech research, and so I will do that. So, what is the new thing about fintech? Well, first we need to know that innovation is very normal to the financial markets. Innovation 9,000 years ago was an abacus. You know what an abacus is? Yeah, this kind of pole with little bubbles on it, and you do the calculation. You know, that was fintech 9,000 years ago. Double accounting was fintech 800 years ago. Today, we associate fintech with algorithms, big data, cloud solutions. Innovation is nothing new to the financial markets. It is the ordinary thing that happens. And innovation is always a way with which you try to disrupt the incumbent business model to establish your own business model, knowing that you will be disrupted over time again. So you have this little window in which you can have a lot of fun and become extremely rich, or just fail. And this is, of course, something that we always need to know when we are innovating and we speak about innovation today. Those are terms that right now may matter, legally, regulatory, financial-wise. And in 10 years from now, maybe entirely different terms are standing there. But innovation takes place, and fintech is not special. Fintech is just another strand of human development, and so in this regard, we should not overestimate it and not underestimate it in their needs. Nevertheless, we have 4 terms to deal with. ABCD is my acronym: algorithms, big data, cloud, distributed ledgers. And what is that? I could now speak about each of that for 2 hours, but that would overstretch my time limit. So let me just deal with distributed ledger technology. Distributed ledger technology is also something very ancient. We see it already on the Polynesian islands, when basically the rice, the stone money, was administered, because this was a kind of distributed ledger. Several people together hold the collective memory of who owns assets. This is distributed ledger. Today we do this technically, but the idea is ingrained in humankind already for centuries. But also the problems. Why did you need so many people? Because these people were usually wise men. Wise men back then were old men. Old men suffer from dementia. And of course, that means you needed to have a collective memory of many people to hedge for the security of the system. Yeah? And today we have the same problem. Yeah? A computer also suffers from dementia. Not in the way how we know it, but when you run an operating system that is outdated, your computer is suffering from dementia today. Because it's not connecting with the rest, it cannot convey the messages that are on there. So again, old problems of humankind now in new clothing, but so it's not so innovative in the end to think this way. The innovation comes from the fact that we now connect this with digitalization and with new technical means that of course come then also with new challenges. Ladies and gentlemen, the mega trends coming from that are, of course, digitalization, decentralization, disintermediation, and technical complexity. So digitalization comes with the fact that people who have been originally trained as bureaucrats, a file-based type of supervision, often legally regulatory background, they have now to deal with new matters of technology. That means they need to understand at least the risks. They don't have to be IT experts, but they need to deal with the risk that's coming from them and put them in the boxes they know. And this was exactly the topic of our first session, where we tried to deal in a conventional manner with these new challenges based on the licensing principle. But of course, decentralization also comes with new issues. For instance, when you think about decentralization across borders, that means that jurisdiction ends at the border. Yeah? Traditional supervision is national or maybe European. That also means when we go beyond that border, we face new challenges of cooperation. And multilateral cooperation on a global scale is a nightmare. It is being more or less moderated by the ESAs within Europe, so it functions reasonably well. But when you try to cooperate across border with third country regulators, the first they ask, well, is that the same activity that we regulate? Is that a licensed activity in my law? Yeah, otherwise I don't have jurisdiction. And then you're already in the regulatory thicket of discussing details of licensed activities even before the supervised entity is around. And that, of course, is a major burden when you want to supervise. So, of course, decentralization undermines compliance with rules, not only for that reason, but also for the reason that in a decentralized setup, no one really gets all of the pie. Decentralization is not only decentralization of cost, but also of profits. And if not a single one captures all of the profits, why should he bring in all the compliance burden for the whole network? And so we see in decentralized settings often an attitude of rational passivity. We know that from corporate voting, we're here in in an institution that deals with private law, so corporate voting will not be entirely alien to you, but we also see it in decentralized provision of services, that they're just waiting until someone else is investing in the respective technology. So, ladies and gentlemen, why is fintech today such a challenge? Because there are so many demands on the fintech systems. There's on the one hand client protection, consumer protection, we discussed it, and openness to innovation. Those were the terms I heard today already, but of course comes market efficiency on top. All of that shall work smoothly and at cheap cost, because transaction cost may be the death sentence of good markets. Systemic risk prevention, extremely crucial. Yeah? When you want to go to your bank account, you want to have money. And or if you don't have access to the banking account anymore, that also means that you can't participate in the economy. And within a very short time, when the financial system doesn't operate well, the markets will go down in the respective countries. So we have here already, with openness to innovation, client protection, market efficiency, systemic risk preventions, some demands. But then new demands popped up. In the last year, sustainability is a major thing. Yeah, we all know that technology also uses energy. Energy is right now in short offering. That means we need to think about how to also provide that angle. Market integrity, AML laws, yeah, money laundering is also something that we don't like, in particular in the context of terrorism, financing. Financial inclusion, very important in countries with a less developed banking system, of course. And today in the developed banking systems, the right use of the financial system becomes a problem. And cybersecurity, of course, is not only a problem when Russian hackers try to hack into the Western systems, but also when a lot of criminals try to strike it big while doing so. Ladies and gentlemen, fintech as such is a complex thing, but complexity is nothing new to humans. It's just what we know for centuries. So when we have here now our traditional system, when we start with the licensing idea, then we all know that fintech firms are trying to move away from the traditional rigid regulation simply because regulation is costly. That's not necessarily because they're evil, it's just because it's costly, it's tedious, you need to ask someone else. And in innovation, it's all about speed, so you want to bypass everything that costs you on the speed type. But there's another reason. Often when you come from the university, you don't meet the regulatory fitness test, which usually requires you to be in command of a financial institution for 3 years before you get a major license. That also means innovators often don't meet the requirements, and that also means they don't have the experience. And of course, that may also turn out an issue in times of crisis. Of course, the idea with eat other lunch without paying for it, that is an old idea in business. Yeah, someone else shall have the cost and I have the profits. And that's, of course, particularly present in fintech. We see often in fintech situations a so-called fronting bank providing a minor part of the financial services, and the back end is entirely digitized by a fintech provider. That's, of course, something where a small bank may think it is profitable, but on the back end, there's the true cream on the pie. Then we have here, of course, the idea that you may disrupt the incumbent, but of course, at the same time, you cannot disrupt the full financial system because that is where you lack the resources, so you collaborate with others. So you pick some incumbents that you want to disrupt in order to collaborate with others. And of course, finally, you want to give an entirely new service level because you need to give the customer a reason to go with you rather than with someone else. And here I take something from a website which I always find quite insightful. The investor in my head was someone who wore a suit and a tie. Well, I can change that. Well, give me a second. Robinhood changed that for most of its customers and achieves then a certain benefit in terms of the customer experience. Congrats on making your trade. Have you ever get that in a traditional financial institution? Why didn't you get it there? Weren't they technically capable of giving you that message? No, because no sound financial advisor would congratulate you just for trading. That is itself a misnomer. Yeah. In my finance lectures that I had, I was told that a trade always implies a cost. And only when that trade is beneficial to me, it's a good trade. Otherwise, maybe not trading may be beneficial. Yeah? So simply congratulating on trading is not only unconventional in the style of the message, it is also contradictory to much of finance insights that we have. And as such, here now we're immediately touching the field of investor protection. Is it good to activate people for trading? Or shouldn't we activate them for some beneficial transaction only? Yeah? Because this is now a kind of confetti scheme just for activity, and this may be noise activity and as such harmful, not only for the clients, but also for the financial system. So we get now to the core point of the presentation, which is it a problem that they act like they do? Well, when no one gets hurt, it won't be a problem. Everyone has a right to throw money out of the window to a certain extent. Yeah? You can squander money. No one forces you to act rationally. But of course, if someone else is in charge and activating you to do it, motivating to act like that, maybe we have a problem in 3 dimensions. On the one hand, there may be a problem with the investor protection, customer protection dimension. Then, of course, we have a problem with the enforcement of public interest norms, and I will go to that into more detail. And finally, we maybe have a market infrastructure issue if we have, in the end, just a couple of important providers in smaller markets that is very often present due to the economics of the software markets. Let me go through that. Do we have, in fact, anyone who gets truly hurt by this? I just pick out examples and that anecdotal evidence, but we can use these examples on many ends. One example very prominently researched meanwhile are initial coin offerings. Initial coin offerings are subject to a major hype at the end of 2017. That hype goes basically until end of 2019. And we have a number of different categories of assets that have been implemented. We did research and we tried to requalify those assets according to 3 boxes, ICO by token reference. What we did here is we looked at 1,000 white papers and compared the own classification by the initiators with the legal qualification under European law. And what we found that remarkably the own qualification of the initiators was always in the utility box. Utility tokens were, according to the prevailing opinion, unregulated by then. That we found basically in the own qualification category more than 95% unregulated. When we requalified them, only 35% were unregulated. That meant those initiators, those backers, were basically not telling the truth about the true economic nature and exposures of their assets. Why did they do it? Because of regulatory arbitrage. They wanted not to avoid the regulation as equity, because that would be then a financial instrument under MiFID, and then the whole prospectus duties and a lot of other things would have applied. And they wanted to avoid the payment services regulation as a currency. So here you see that they were actively trying to escape the cost of regulation. And of course, that also comes with a lesser degree of investor protection. That's the reason why we ask for a prospectus, because there's a huge information asymmetry between the initiator and the investor. For that reason, we ask for the prospectus to kind of balance this information asymmetry and at the same time impose certain liability for non-compliance. For that reason, you have to disclose the backers of a certain initiation. You have to disclose conflicts of interest and major risks, and when you don't do it, you're liable. And this is the way how, as lawyers, we try to remedy with this information asymmetry. And of course, this very mechanism was basically ripped apart by the own qualification of these respective asset classes. Another aspect is, you don't see now the heading, and I'm very sorry for that, but this is Wirecard. Yeah? So Wirecard had basically a major problem, as you know, and what I wanted to show is that in the Wirecard domain, there was a very small part of a licensed activity of a bank, and a huge global part, which made the major value of the firm, which was unlicensed. That was unlicensed global. That is a nightmare of any regulator. Why? Because in this situation, you cannot really go on the license activities because you don't understand what's going on in the unlicensed global tech activities. Yeah? And this is a typical multi-activity group that you see also other firms, Apple, Google, Amazon, have similar setups. Yeah? So that is a major problem. Of course, if the problem from the unlicensed activity infects the licensed activities. And in this regard, it's crucial to understand that when we speak about the licensing principle, it's not so much the problem in the license principle. Often the problem stems from the unlicensed activities and infects the rest. And how to deal that is, of course, also a major policy issue. Well, we have many other public interest aspects here, and I'm sorry that you don't see the heading here, but of course, in the public interest, we have to enforce sanctions. We know it also then when we speak about monitoring AML and KYC aspects. The buildup of a systemic risk is something that I will also discuss in a minute. Regulatory learning is extremely important. It is underemphasized in the literature, but regulatory learning is a major aspect of a public interest, because when the regulator cannot learn together with the market, it will lose the control over the market risks, and of course ensuring cyber resilience. Let me give you a very famous example. This is Ant Financial. Ant Financial is the largest fintech of the world, and they grew in 3 years from being not relevant to being too large to fail in the Chinese market. That is really something where you see the full dynamic of fintech. Today, they hold more than 60% of all payment transactions in China in a single entity. Of course, they're today regulated, but here the Chinese regulator in 2018 onwards had a catch-up game to make, because in the original setup, much of the activities of Ant were simply unregulated. And here, this is for me the best example how things happen when we don't act. And why did they grow so fast? That is in the economics of software. In software, the first copy is extremely expensive, the data center, the algorithms. The second copy has almost zero cost. So you have a huge scale economy, and the more clients you bring over your software, the more liquidity you get. And in the end, you have data plus liquidity, which is in the financial markets basically the key advantage to a successful firm. Another aspect is the increasing aspect of the public interest in technology as such. We want to understand in a fintech environment technology not just as a resilience matter, it's an access matter. Think about the crisis of the last years we had. Without our online banking, probably nothing would have happened. That was a major problem for my 85-year-old grandmother, by the way, yeah, because she was technically excluded from the system, although she had whatever, cell phone and so on, but she simply couldn't handle it. And I think much of the society was similarly excluded. But in the end, other people were able to survive simply because of the digital access. And today, in the fintech world, technology is such an access thing. It is a front-end thing. And what is the difference from the regulatory perspective is when something malfunctions on the back end, usually no one notices other than the intermediary and the regulator, because they together solve the problem. Usually in the public interest, they keep it small, because no one has an interest in a bank run. No one has an interest in a frenzy towards the banking system, yeah? Because that will ruin the deposit base, and then the next day you can shut down the bank. So for that reason, usually you deal with the crisis, clean up afterwards, make policy measures, make things more stringent. In the fintech world, that doesn't operate anymore when the front end is digital. Because here, when there are malfunctions, immediately the public will lose the faith in the system and the bank run starts. For that reason, we need to make sure that we have access in a place, and that requires expertise. It requires also a lot of knowledge about the inner workings of a financial institution. That is not just easy, because you need to connect with all the capital requirements, with all the steering and so on, and usually a simple fintech firm is not capable of doing that. So because they provide these little pain points, you know, so these little collaborations. So the major setup is usually not governed by a traditional fintech firm. And of course, that brings to the next aspect of interlinkage and asymmetry of information. When the knowledge is in the tech part, it doesn't mean that other parts of the system aren't affected. It could well be that a major malfunction, for instance, the trading algorithm, ruins the trading book of an investment firm, and thereby the whole setup turns into a difficult situation. Why do I say that? Because when we deal with technology risks today, we see more and more that these interlinkages create a problem for those in decision-making capacity. Because no one knows that you have a problem until you have one. That sounds so extremely absurd, but this is the way that the information flow from the tech floor to the top floor is usually not smooth. Why do I say that? I was a tech entrepreneur, and I can tell you, when I went to my 20 IT engineers, asking them whether the software that we needed the next morning at 8 o'clock was fine, they said, bring us more pizza, we are fine. At 10 or 11, the temperature in the room was increasing because people were starting to sweat, and so I went in, bring us more pizza, we are fine. Until they admitted that they had a problem, it was very late in the game. And I, as an executive, I would have loved to know about this problem a bit earlier, because then I would start with the client, maybe communicate that we delay, whatever, do whatever. But if I don't know, I can't manage risks. And this type of different attitude inside financial institutions is a major hiccup when we deal with technology today, because the risk approaches of organizational and legal stuff is just entirely different than the technology flow. Finally, we deal with competition and market infrastructure issues, and since I will address that in a minute, let me go to my next slide to show what this entails. When you have a major fintech firm, usually have a financial system ecosystem core. We can here go, for instance, to End, or we can go also to BlackRock, Aladdin's, or to many other of new technology-driven firms. And around them, there are a lot of linked services. These linked services are side services, but they make the difference from the client's perspective. These may be analytical tools for your personal finance. These may be a kind of community chat where you can discuss the latest good investment or bad investment, as the case may be. All of these linked services give the special experience, and you have the financial ecosystem core. So the true competitor of the linked services is not the other linked services, but the financial ecosystem core. Because whenever a service on the linked side is too profitable, the financial ecosystem core can go into that because they control the access. And we see that this type of phenomenon lets markets tend towards concentration. We see increasingly big tech firms taking over sufficiently large parts of the markets. As said, end with 60% of the payments market is of course one of the major examples, but we see similar things inside infrastructure, for instance, in risk management tools. Yeah? So we have one risk management tool providing risk management to more than 10% assets of the world. So what happens if that risk management tool is wrong? Yeah? All the large asset managers of the world basically rely on one system. And that is a problem not only from a market infrastructure antitrust perspective, which may be a lesser concern for regulators, but I argue for quite some time that we have here also a systemic risk. We have a single point of failure. And this is a financial concern for sure. And for that reason, regulators need to deal with market infrastructure to avoid this single point of failure. Ladies and gentlemen, now I spoke about the problems. What are the remedies? What can we do about it? And as often in law, the answer is it depends. It depends entirely on the severity of the problem and on the assets and the services at stake. So the easiest thing is doing nothing. That sounds awkward, but I heard it already for the insurance sector here today. In small market with very little service offerings, it may be better just to let things develop and let some players provide a service which otherwise would not be there in the first place. And doing nothing is not always the wrong solution when you want to further a given digitalization streak. It may also be good for the regulators, because as long as you do nothing, you can be in a very relaxed way observe and learn. And this is definitely one strategy which I don't think is good for everyone, but it may be good in particular in a structured innovation environment. And here we have two types of things. When you are in the regulated activity, then many people speak today about regulatory sandboxes. I'm much more a fan of what we call innovation hubs. An innovation hub is a contact point where regulators and innovative firms can talk. Maybe they have a tea together. Yeah? They exchange their views about things. This is a very unstructured way, but this almost random way usually leads to an atmosphere where the one side is quite open about what they truly can. Because when you're in a regulated environment, there's a top-down hierarchy. In an innovation hub, you can talk, you can play cards together, you can drink a tea, and thereby truly learn from each other. So in a structured learning environment, I think innovation hubs are much better than sandboxes, because a sandbox, there's all the onus and also the liability already with the regulator. The other thing is, when the other option that we have here, and I'm sorry that again my headings are cut off, that the second option would be delegation, indirect regulation by way of delegation. This is also an option that's already discussed, but here we have a problem of the sizes. When you have a small and medium bank dealing with the Googles of this world, then the tail is wagging with the dog. No one can force Google to do things that they don't want, because their balance sheet is so large that they can buy any financial institution in the world. Yeah? So you can't force Google to do things as a private entity. And delegation is essentially about enforcing your own interest against the delegate, and that will not work in a tech environment where the delegate is larger or much more successful than the regulated institution that delegates out. So delegation arrangements may work in size environments where the financial institution is big, large, and financially stable, but that's unfortunately not the case in many instances. Another way of dealing with things is that we expand the existing definitions, and here we have two examples where we did that. MiCA, that was already mentioned today, is a case where we anticipate that some financial services authorities have already expanded the use of, or the definition of financial instruments to include, for instance, securities that are embedded in tokens. Yeah? Tokenized securities are also financial instruments under the interpretation of, I would even say, the majority of EU regulators today. That is one way how we can do it. We just accommodate to the innovation and don't think only that the paper-based centralized security is a security, but also a tokenized one. the next option is that we define entirely new activities with a certain exemption for materiality. And there's two ways of doing that. We proposed in 2017 to deal with END by embedding a new regulated activity called financial data processing. Financial data processing is a very broad catch-all definition, and then you exempt the smaller ones. So this one, you get the material ones that can really let you put your system under stress. Another way where we see that now happening is basically in the MiCA with the issuing of crypto assets. Issuing of crypto assets is nothing else than a new licensed activity with which we want to bring certain activities in the regulatory perimeter. Even there are size-based exemptions. MiCA applies, depending on which draft you look at, from 5 million to 8 million issuance volume only. That means that very small ones are out, and these very small ones make up, I think, a third or even more of the market in crypto assets in Europe. So that means you have a size-based exemption paired with a new definition. Then what you can also do, and that was discussed in particular in the Wirecard context, you can basically try to bring in group structures in the sense that we look at multi-activity groups and think more reasons for regulating the group as such. FICOD right now is based on regulating in banks and insurances. So in the future, you could also think that a major payment provider or payment technology provider would trigger a FICOD group supervision. But the problem here is again the same that we have with the licensing principle everywhere, that you need to define who is part of this group supervision, and that means you don't really have a solution. You have only the approach that you want to have more in the regulatory scope, but no solution how you get there. Well, I have a wonderful example where I think that regulation may also work in the absence of financial regulation, and that may be in the field when we have financial services agnostic regulation in place. So for instance, for the AI, we have the AI regulation right now, but also, and we're in the Institute of Private Law here, private law is as such tech agnostic. And I give you now an example how you can deal with private law to deal with things. Here, I gave you here 3 examples of so-called digital autonomous organizations. And under many laws, these are seen as partnerships, and that leads to personal liability. You still have a bit of a problem, but of course personal liability is a very strict legal standard of any note that may not be efficient to deal with many things, but for addressing certain pain points, private law may be a very good supplement of financial regulation, in particular when we want to allocate responsibility of key actors. The downside of private law, partnership law, is that you can sue even very small notes, which may have no influence. But I think when we think more of a limited partnership, then we're in the right spot, because when you think, for instance, of the Dow has lost around 52 million euros, and there were a handful of programs in charge back then. That would be, for me, the typical general partner that I can go for. So with liability schemes, we can go after certain instances, in particular when we look now at the enforcement of digital claims. In the past, we couldn't really enforce, for instance, the stealth of crypto assets, but meanwhile, we know where these assets go and then put a lien on these assets at the depositories. We call them wallets, but wallet providers are nothing else than depositories, and thereby we can seize assets. And that's important when you deal with major criminals, because these criminals should not retain the assets. And there, private law may be more efficient, in particular, since we have certain instances where criminal acts could be remedied by way of private law. Okay, another field of cross-sectoral regulation is, of course, data protection and cyber resilience. Those are, meanwhile, regulated in the absence of any type of financial licensing. I'm done now. So, and now, the final thing that I want to bring to you, and this is a kind of accident in the legal policy, that's Luxembourg's law on professional services in the financial sector. It was introduced originally to cover trustees that were not regulated, but had influence over clients' money. This law on professional services in the financial sector was adopted in the early 2000s. Today, it functions as a controlling device over certain ICT-based financial services firms, because they cover all added value services. And today, when the CSSF wants to have information from any player in the market and can rely on this PFS law, how we call it, to get transparency, imply fitness and properness, and also proper organization. That was a legal accident, because in 2004, 5, 6, when this was implemented, no one thought about fintech. But today, it functions well to bring certain fintech firms into the perimeter. I'm done with my presentation, and my key takeaways are: if fintech is properly regulated, we will be quite happy to have them because they provide major benefits. But in the absence of regulation, I think we will have also certain difficulties. But it's for sure that the difficulties don't only come from the lack of regulation. They also come from the speed of innovation and the lack of expertise on all sides. And this includes regulators and regulated firms, yeah? Because very often one issue is what they know or don't know about regulation. The major remedies, I introduced them from doing nothing to applying specific laws. I think which solution is the right one entirely depends on the case, and we shouldn't spill the baby out with the water by broadly expanding all licensing principles, but we also should not be passive. So the answer lies in a basically careful regulator being open to innovation, but with the entry and the doors. Thank you very much.